All right, we're looking at 415 here. Given how we like to be prompt, let's get things going.
I like
So,
it.
welcome everyone. Casey Snyder and Tom Sidorik here, and we want to thank you for making time for this afternoon's The Sidorik Group's regularly scheduled semi-annual market update. And due to popular demand and permissions from compliance, we've moved to a webinar format to provide the ability for those who are more visual to follow along. So the flow of the conversation today will be similar to prior calls. As we first, we're going to look back at the last 6 to 12 months. Then second, we aim to provide some context about markets today as we look towards the future. And then third and lastly, we'll conclude with some important themes as we look ahead. Hint, we are going to discuss this being an election year from a market perspective, but we are going to do so without allowing the conversation to become political. And assuming we stay within the boundaries of compliance and compliance signs off on this, this webinar will be available for replay. And when it is, we'll send it out via email. But with this being a webinar, we do not have the normal functionality for Q&A at the end like we usually do, and instead welcome any questions via email, or feel free to give us a call after. We're happy to discuss whatever's on your mind. So with that, Tom, let's begin with a few subjects that typically don't rank high on the excitement scale, but impact everyone from a financial perspective. So let's start with the subject matter of inflation. And inflation obviously impacts everything from policy to valuations, returns, and as consumers, we see it on a daily basis, whether it be gas, eggs, lumber, etc. So, Tom, will you please provide some brief commentary perspective about where inflation is today versus, say, 1 to 2 years ago?
Absolutely. And I think the kind of the latter part, far right in this chart, displays it. Inflation is normalizing. It did spike. We got as high as 9%. Certainly nothing like what we experienced back in the 70s and into the 80s, but it did spike. What I think people are probably slowly starting to feel is that it is normalizing. There's certain areas of the economy where inflation is still a little sticky. Housing prices are still sticky. Certain commodities are still sticky, but overall, inflation is moderated and normalized to a much more healthy level. And I guess it's not the concern that it was. I remember early on they talked about it being transitional. It certainly was not transitional, but now inflation is a much more normal range.
Yeah, I think we touched on this subject during the COVID era about how things like lumber in particular, it just takes time to sort of recalibrate and sort itself out. And I don't think we can talk about inflation without talking about interest rates. The two sort of go hand in hand. There's been a great deal of skepticism surrounding the Fed and their actions over the better part of the past decade. Jerome Powell has certainly received his fair share of criticism, but as you can see in this chart, rates are back within a normal range, and they did so with the economy still being relatively strong. So, Tom, if you can speak a little bit to interest rate cycles, where interest rates are today relative to the past, and maybe some of the volatility that we've seen.
Well, the volatility first, Casey, you know, and I know that the last 3 years in the bond market has been historic. It's been one of the rockiest, most volatile bond markets in history, actually going back as far as the 1840s, which doesn't quite show on this chart, but you can see how normal things were from 1870 through 1970, and rates were quite normal, and then they spiked again. They have normalized once again. We feel pretty good about that. I'm actually, in many respects, pretty excited about it. One of you was kind enough to send in a note and a message and a question before this webinar asking about the banks. And I will admit that the banks have been somewhat sticky in recalibrating their payment to their depositors. So if you're looking for better yields, sometimes the banks are not the alternative. They are a financial intermediary. They do try and make money on your money. So there are alternatives to bank deposits if you're seeking them out. But rates are normal. And that's pretty exciting. It hasn't been the case for the better part of the last 7 or 8 years. And we find this very refreshing for investors, particularly retirees.
Yeah, and when I look at this chart, I like to equate a chart like this that depicts interest rate movement over a long period of time to that sort of like the Maine coast. From afar, from a satellite image, the Maine coast looks smooth and steady. And anybody that has spent any time on the Maine coast knows that that is not the case. It's jagged, it's full of coves, and it's rocky. And so even though a chart like this shows these trends as being maybe relatively smooth, fun fact, interest rates move over 0.5%, 96% of the time over rolling 6-month period. So there is a tremendous amount of up and down movement over the course of any given year, even in alignment with a longer term trend. So, but that's just really more of a trivia fact than anything else. If we move away from the bond market here for a minute into a subject that I think people find more exciting, let's talk about the U.S. stock market here for a minute. And in particular, kind of the magnificent concentration that we're seeing within the S&P 500. So Tom, which chart would you like to begin with here? And then we can go from there.
Can I say neither of the above? Just joking, but I think we'll take the multicolored one, which shows the incredible dominance of what now is being called the Magnificent Seven. We've talked about other concentrations. We talked about the Nifty 50 back in the 60s. We talked about FANG a couple of years ago. But look at the enormous capital concentration in these names: Apple, Microsoft, Amazon, et cetera, and then compare them to global issues, like global economies. It is huge. So these technology companies really do dominate the market. You've heard me in the past talk about market breadth. Market breadth is still relatively narrow. It is heavily concentrated in the names that you see on the left in the multicolored segment of this chart. It is broadening out a little bit, but not a lot. So we still look at market breadth, and it's lacking to kind of lift all the boats, so to speak.
Yeah, and I'll tackle the chart on the left here as it relates to last year's performance within the S&P. What you can see here on the left is the green line is meant to represent the top 10 names in the S&P and its performance or their performance in 2023. The dark gray represents the S&P overall when you include those top 10. And if you look at the light blue, that's the other 490 companies in aggregate. And what you can see here, to Tom's point, is that big tech and those big 7 names or big 10 names are really driving the vast majority of performance. If we were having this conversation in October, the 490 other companies were actually trading in negative territory. So it was a very, very uneven, call it, recovery in 2023. And it wasn't until interest rates, or I'll say differently, it wasn't until the prospect of inflation having been quelled and interest rates beginning to fall in 2024, where the rest of the market actually turned positive at the very end of 2023. So this is a pretty unusual distortion. We're approaching some of the highest distortions we've ever seen on record, and kind of wait to be seen what happens from here. The distortion, though, is largely a U.S. Related phenomenon. So when you think about big tech, you can see on the right, U.S. and big tech have been synonymous for the past 5 or 6 years. But that's not the case overseas. Tom, so given the dramatic run up in big tech and the weighting of the Magnificent Seven, some today are drawing parallels to the tech bubble or the late 90s. Can you speak a little bit to maybe some of the similarities, but maybe more importantly, some of the differences when you compare today to the late 90s?
Sure, Casey. The dot-com bubble coming into the year 2000 was kind of an anomaly. We had a lot of companies that were not profitable. They were a name and they had .com after their name, and they were fueling markets to go higher. So you had a lot of kind of ghost companies that were hot and unicorns. You've heard the name. So that is very different today. Today, these are real companies that have real profits, have real money that's going to their shareholders eventually in stock appreciation, but also future dividends. So it's different than in 2000. What I think is particularly fascinating, however, is the dominance of the technology names and how, in many respects, and a number of writers, particularly Ian Bremmer from Eurasia Group, have written about the dominance of technology companies are now beginning to usurp the sovereign nature of many nations. And I know that's a hard thing for people to wrap their heads around, but technology is now dominating sovereignty. And I think that's a very interesting thing to think about. And it's something that, as an investor, you have to have a very, very global perspective on things, not have your blinders on and just think about your own country.
Well said. So we move over into the bond market, continuing with our look back on 2023. What we can see here is, as of October of 2023, again, right here, the bond market was on the cusp of its third negative year in a row, something which has never happened before. And it really wasn't until November, again, with the prospect of inflation having been quelled and the idea that rate cuts were on the horizon in 2024, that the bond market suddenly reversed course, leading to one of its, or actually to its best month since 1985. So if you close your eyes in January, open them up in December, bond market had a pretty decent year, but the ride in getting there was very volatile. I think this provides a really important behavioral psych lesson because many bond market investors by September, October, were really on the brink of capitulating, kind of throwing in the towel because they weren't receiving the near-term results that they desire. And this is common. Studies show that negative performance over the course of 1 year, okay. 2 years, investors start asking questions. You get to a third year of negative performance, and investors are usually looking for some sort of action. It elicits the desire for an action. But in the grand scheme of things, 3 years is a relatively short period of time from an economic or market perspective. But I think when we personalize a 3-year time period and align it with our goals or our lives, suddenly 3 years can feel like an eternity. And I think a great example, Tom, of what we saw, we saw this fall, is that a 401k portfolio management company that has affiliations with major airlines and S&P 500 companies, and they represent tens of thousands of participants. They actually suggested to their participants that they reduce their equity and fixed income exposure significantly in favor of cash in the fall of 2023. And therefore, they ended up missing out on the recovery, and not just in the bond market, but the stock market as well. And if that's not an example of capitulation and behavior psych, I don't know what is. So anything you want to add to that, Tom?
No, I just think it's a reminder to all of us that market timing's never worked, it never will, and this consultancy to these large retirement plans and 401k plans and the pilots you mentioned, Casey. Quite frankly, I think somebody should be asking hard questions about, we hired you for discipline and you abandoned your discipline at the worst possible time.
Yeah, and I mean, to that point too, Tom, the best returns tend to follow some of the worst. And it's depicted right here. You're looking at a 3-year down market in bonds, and then suddenly it reverses course. So worst possible timing ever. Talking about maybe not getting it right or not knowing what the future has in store. If we move away from markets and into the economy at large, 2023 sort of defied the pundits and the forecasters by avoiding a recession. And this was something that we actually referenced in our was it January? Yeah, January of 2023. We referenced that, hey, when everyone in the room is expecting the same thing to happen, rarely does it actually play out as expected. So you can see December 2022, the outlook was everyone was convinced there's going to be a recession. Now you look at the outlook at the end of 2023, and you can see it's very much a mixed bag, with, I think, the consensus from the investment world that there will be a recession, albeit it may be very minor. Tom, we know economic projections are important for the sake of guidance, but can you speak to, I guess the folly of forecasting and why, from your perspective, why are recessions so difficult to predict with any sort of success or consistency?
Sure. We wrote a piece, I think it was a year and a half ago, 2 years ago, about the folly of forecasting because we don't do it. And quite frankly, it's a waste of time, very honestly. What we do, however, attend to is what's called capital market assumptions, which I know you'll get into in a minute, Casey. We look at, the think tanks and what possibly could happen in various asset classes over time. This just shows you, turn off CNBC because I can't tell you how many times we've heard the word recession on the various news outlets over much of 2023. And we had no recession. And if we have one coming up, fine, but nobody can predict them. And all the economists were wrong last year. And now, of course, everybody's saying, well, maybe it'll be a light one, maybe it'll be, we don't know. But what we do know is we've developed plans and we've constructed portfolios for our clients very attuned to your specific needs.
Well, and when we think about the economy versus maybe reality, I think this graph depicts, the significant disconnect between how people are feeling about their own financial situation versus how they're feeling about the economy. And Tom, I'm going to pick on you here for just a second because, you're the self-proclaimed pragmatist. So when I hear you speaking to clients with a half glass full approach, spreading the cherries, I know there's some serious negativity out there. So if you can share a little bit about some of the conversations you're having and maybe, what people are feeling versus what's really going on.
Sure, I'll talk about one particular discussion I had very recently. It was actually last week and this is a gentleman who's been in our business. He's now retired, managing his own money. And he was so down. He was down on everything. He was down on the economy, down on the world, down on the US, down on our future. And I kind of had to step back and I said, well, and I won't use his name because it's unique, but I said, friend, let me ask you this. Why is employment so strong? Why is the stock market at all-time highs? Why are interest rates normalizing? And why is your portfolio considerably greater than it was just a couple of years ago? And he said, well, yeah, I know that, but things are really terrible. And I was like, but they're really not. And I think it's sometimes the news cycle that gets us because, bad news sells and good news doesn't. And to Casey's point, I am a pragmatist. I'm not an optimist. I'm not a pessimist. But I think things are a whole lot better than we give them credit for. And I know that this is not universal across all segments of the economy because those less fortunate are still struggling, and those of us that are more fortunate are not feeling the effects. But the world is actually in better shape despite the wars in Ukraine and despite all the tension. I'm concerned a little bit about our democracy, but other democracies around the world are working beautifully. So don't, as Warren Buffett says, don't bet against us.
So if we change gears now, we move into the second segment of our call today. We are now going to look ahead instead of back at 2023. This is a chart that everyone, I believe, has seen before, but it is updated monthly, so this is not stale. And as you can see, the recovery in the S&P in 2023 has pushed valuations back up into an unusually high valuation range. We're back up into a 3 standard deviation, valuation range. And just as a brief overview of this page, for those who don't recall, the black line across the middle represents the mean dating back to 1870. The shaded light blue represents valuations during different eras. This was the tech bubble in the late 90s that was approaching a 3 standard deviation. This was 2021, the end of it, when we were screaming to everyone, we don't know how this will change, but it will, because valuations this rich do not last forever. We did not know 2022 was right around the corner, but sure enough, it was. Valuations fell, and then 2023, with the sort of uneven, imbalanced recovery, brought them back up. A lot of this, though, appears to be attributed to big tech in certain sectors, because I think when you peel back some layers, there are certainly areas of the marketplace that are much less expensive. The Russell 2000 index, which is an index that's made up of the smallest 2,000 publicly traded companies here in the US. It's meant to reflect the health of the small business world. This index remains in bear market territory. It has not recovered from 20 or back to its highs in 2021. And there are other segments of the US market that also appear relatively cheap. High dividend payers is something that we're going to get into in a minute. So yes, it looks expensive as a whole, but there are certainly areas of this market that are not as rich as they may appear within this chart. Tom, anything you want to add to that?
No, I just see your point, Casey, about using the Russell or any value index. There's a lot of value out there. We've talked about, and I know you're going to get into it in a minute, about the foreign markets. There's great value there, and people don't focus on it. They're all focused on it used to be the FANG, now it's the Magnificent Seven. The S&P 500 is not a reliable measure of what the real market health is.
Yeah, I think that's an important point, given that 7 companies make up about 30% of it.
Casey, Matt, I just want to bring up a little piece of
Yeah,
history, though. This is a chart that you've heard me reference in the past, and now because we're on a webinar, I can actually show it. This is a chart that I used to use. This is late 90s, where valuations were really extreme, and we tried to warn people that it wasn't going to continue. So we're kind of warning you now that the big name techs, as much as they've been very strong and they certainly are profitable enterprises, don't chase after them. Please don't.
yeah, we've got some fun charts here at the end about that theme. So, if we move into and Tom already touched on this to a certain extent, we do very much pay attention to what are called capital market assumptions. And this chart here is a set of capital market assumptions provided by Vanguard. So whether there be a recession this year or next year, or whether the concentration continues, their capital market assumptions, this is when they look out 10 years. So basically, we're having this conversation 10 years from now, and this is what they're suggesting that the range of returns may be. What you can see within this chart is that the projected returns have all improved, whether it be US equities, global equities, US bonds, or global bonds. Projected returns have all improved when compared to 2021. So the light blue shaded bar here was meant to reflect projected returns at the end of 2021. With markets having come down some in 2022, you can see that those forward-looking projections improved dramatically. Yes, with the recovery last year being what it was, they've come down slightly here in the US. But look overseas, to Tom's point, and we're going to show a chart here in just a minute. Foreign equities look pretty attractive from a long-term perspective. And look at the dramatic improvement in the fixed income world. These were not pleasant. These were very concerning when you think about a world that may be stuck on 1 to 2.5% returns within the conservative sleeve of portfolios. So the message here is that, hey, maybe the US stock market is still abnormally expensive, but the outlook across the board has improved dramatically compared to where we were 2 or 3 years ago.
And if I'm running a pension fund or an endowment fund, this is very welcome news, quite frankly.
Yeah. Coming back to those dividend pairs that we just mentioned a few minutes ago, Tom, the broad market again may look rather expensive, but dividend pairs, I mean, look at this chart here. Dividend pairs were kind of left behind over the course of the last couple of years and show tremendous value. So can you speak to, I guess, the importance of dividend pairs in general and kind of how they evolve over time? Because they do.
They sure do. And I've mentioned this on prior calls. I'll mention it again, that for much of the history of the S&P 500, for a good long period, probably 100 years or so, a good piece of the return on the S&P 500 was in fact the dividends that companies in the S&P 500 paid. It's only been recent years, last 10, 15 years, where dividends were kind of lackluster and all the return in the S&P 500 was appreciation. That will probably normalize over time. And we think dividends are still very important. And we'll talk about foreign markets again and valuations. So for many of you that when interest rates were at zero, and we were struggling and charged with the issue of providing income for retirees, it was the dividend payers that bailed us out.
Well, and Tom, I mean, going back a couple slides even in the chart that you held up, I mean, look, yes, the US stock market may be expensive. The US stock market may have looked expensive in the tech bubble, but there were plenty of segments within the US stock market that were not part of the tech bubble that actually delivered pretty respectful returns in the decade of the 2000s. So I think when we see the chart here today, similar, hey, dividend payers were out of favor at the end of the 90s as well, as big tech once again kind of stole the show. So when we look at this asset class today, there's the compounding element to it, there's the income streams from it, and they also appear relatively cheap and attractive compared to, again, other segments of the marketplace. So
Yeah, and quite frankly, it was not owning the .com names in 1998, 1999 that saved our clients and saved my practice, quite frankly, Casey. I know you have heard me talk about it.
sure.
But it was in fact the value names, the companies with dividends that saved our clients in 08 and 09, saved them in 2000, and saved them again more recently.
On this one, we're going to sound like a broken record on this. And we know we do. Okay. This has to do with international valuations. We've been saying now for a handful of years that international markets look relatively cheap compared to their US counterparts. And they do. That message continues. And to some extent, they're now cheaper. But it's a busy page here. So I want to just give you a very brief explanation here. On the left-hand side of the page, what you see here is the lower that gray line goes, the cheaper non-US equities are relative to US equities from a valuation perspective, okay? And what you can see here, when you look at valuations, they're as cheap as they've been over the course of the last 20 years. On the right-hand side of the page, the higher the gray line goes, the higher the income streams are, or the dividend yields are, compared to their US counterparts. So when you put these two together in the sense that foreign equities are historically cheap compared to the US equity markets, and by the way, they're paying a historically higher sum in terms of dividends, the combination of these two could be a very unique and attractive combination for a long-term investor. We don't know when this will turn, but markets do have a very long history of being cyclical. And these sorts of distortions tend to not last forever. I mean, they change.
And markets do mean revert. And if you need validation for what Casey just talked about, all you have to do is walk into your garage, look at the brands of vehicles you own, and even if it's a U.S. name, it may not be all manufactured here. And do the same in your kitchen. You'll see the value of foreign companies and why you can't ignore owning them going forward.
Exactly. And maybe we'll show the similar chart next year too, but who knows? All right, moving into the bond markets. You know, we just talked about the US stock market, foreign equity markets, dividend payers. Let's talk about the bond market now looking ahead. Tom, I think it's hard to overstate the significance of these higher yields compared to where we were only a few years ago or compared to the last 14 years. So can you discuss the beneficial ripple effect of the reshaped bond market as we now look ahead?
Absolutely. As I said a minute ago, we're kind of excited about the current bond market, the current interest rate environment, and the outlook for bonds. They're back. They're not very sexy, but if you're retired or you're approaching retirement and you want some stability and you want some income from your portfolio, I can tell you that the bond yields today are vastly improved over what you saw just 3 or 4 years ago. 3 or 4 years ago, quite frankly, we were scared because we were having to chase after things that we didn't necessarily want to own, and now we can own bonds and feel pretty good about it.
Yeah, and I think if we personalize this, and this is something we did a couple years ago during that low interest rate environment, we sent out a chart similar to this. I think it was fall of 2020 or fall of 2021,
Yep.
where we kind of provided a sense of like, hey, here's the implication of these really low rates, and here's how it's going to impact in terms of people's savings rates or what they may need to accumulate. So this chart here gives you a sense of, in the yellow shaded cells, this is meant to reflect where interest rates have been over the better part of the last 14 years. And then if you see, you can see how much money somebody would need to accumulate to generate $50,000 of income, and then how many years it would take to double your money. Come down to the light green shaded cells, and here's where interest rates have been for the last year and a half, give or take. And what you can see is, all right, an interest rate of 4%, someone needs to accumulate 1.25 million to generate the same income stream compared to somebody who needed to generate or accumulate 5 million. Money doubles in 18 years versus 72 years. These are real numbers. Nobody can say that we are not in a better situation today than we were a couple years ago, even if balances haven't fully recovered, because of the implications of higher interest rates. These are profound.
And this is particularly beneficial to the endowment world, the insurance companies that need a return on their cash on hand. It's also improving the bank situation in many respects, although we've had a couple failures and may have a couple more before it's all over. But this is a much healthier environment for fixed income than it has been in a long, long time.
And if we're going to talk about bonds, we do need to, I think it's only appropriate that we differentiate, I think, two important segments of the bond market. There's the taxable aspect of the bond market, meaning bonds that are subject to ordinary income taxes, and then there are tax exempt bonds, municipal bonds. And so if somebody is looking to incorporate bonds within their portfolio, it then becomes a question of, well, which type of bond may be most appropriate? And this is really unique to everyone's individual tax exposure. And what it comes down to, I mean, you can see this on the far right hand or the right hand side of the page, is that if somebody is living in a 29% tax bracket or higher, it may make sense to incorporate tax exempt strategies, versus if somebody's in a 29% or lower bracket, where it may make a lot of sense to own taxable strategies. These are the kind of things that we're thinking about on a regular basis, with the intent and the goal of trying to maximize one's net after-tax return. And frankly, up until the last couple years, rates were so similar that it may not have made a big difference, but now it does. And that's something that we've been engaged with or working on your behalf over the course of the last 2 years.
And Casey, you deserve a lot of the credit here. I talk about early in my career, I would spend, maybe 15, 20% of my day talking to accountants and lawyers, maybe about estate plans, but accountants particularly about a client's effective tax rate. And I would argue today, 30, 40% of our days spent talking to accountants, because it is a very unique and client specific issue about where their tax rate is and whether they should own taxable or tax free bonds, or quite frankly, maybe a blend of both, depending on the distribution strategy we have in place.
Right.
So you've done exceptional work in this area, and this is something that is a huge value add for our clients, and the accountants certainly understand it, and most of our clients are starting to understand it as well. So kudos to you.
Well, thanks. It's fun. All right. Now we're going to discuss some key themes, and we're going to come back around to what you mentioned earlier, Tom, about chasing returns. And we enter into the third and final segment here of today's call with some key themes to keep in mind. And really, for those who seek to chase returns or think they can outwit the market by investing, for example, in last year's worst performing asset class. Just don't do it. This chart dates back to 2006, and what it shows is if an investor invested $100,000 in the prior year's best performing asset class, 18 years later, it's worth $40,000. If they tried to be witty and contrarian and thought they could outwit the market and they invested in last year's worst performing asset class, yeah, they came out a little ahead. But really, it's that disciplined blended portfolio that comes out ahead of both strategies. And it's just a reminder of the importance of maintaining discipline, even if it doesn't provide the immediate benefits that you're looking for. And this is kind of helpful, or I guess trying to find that balance between greed and fear as well.
There's also a corollary to this, Casey, and we've talked about it with some of the newer situations we've been asked to consult on, where we get a portfolio for an elderly or older couple where it might actually suffer from benign neglect. So you see a lot of the popular names of the 1960s and 70s, but they don't have anything that represents the new economy, the technology that has been so strong. So, investing in the rearview mirror has never been a great solution for anybody. Probably more important now not to do it. So if you've got family members that you consult with, just ask them, when's the last time they had somebody look at their portfolio?
Well, and it's so important. We have a few slides here about this theme. This next one here provides, I think, greater historical context, and it's less about chasing last year's winner and more about trying to refrain from getting sucked into kind of the momentum of maybe unusual trends. And so this chart dates back to actually 1927. And it shows the average annualized outperformance of companies before and after the first year they became one of the 10 largest in the US. And we think this is especially relevant now, given the Magnificent Seven and given some of the distortions in tech. So what you can see here is that outperformance 10 years before joining the top 10, 5 years before joining the top 10, and then 3 years before joining the top 10, you can see performance is pretty incredible. After joining the top 10, look at how that performance tends to change. And this really speaks to market structure, and something that Tom's already mentioned about the Nifty 50 back in the 60s is, markets evolve. Great companies don't always equate to great investments. Doesn't mean they're not great companies. They just might not be the great investment of their era any longer. So how those Magnificent Seven play out, how they continue to reinvent themselves, based on history, the top 10 are likely to look very different 10 years from now. There might be one or two still around, but they do have a long history of shifting.
Amen.
And then lastly, on this theme, even though we all know not to chase, investors do it anyways. Okay, so the chart on the far left-hand side of this page shows monthly inflows into the S&P 500 dating back to 2004. And what you can see here are these lines, inflows on top, outflows on the bottom. Well, look at that one line that stands above all the rest. That was December 2023, the largest inflow into the S&P 500 that we've seen over the course of the last 20 years. So we talk about not chasing, everybody knows not to chase, but yet people do it anyways. And if you look at the chart on the far right, what you can see is returns over the near term following these inflows tend to be below average, especially those really high inflows in the top 10. So, what happened in December eclipsed anything that we've seen over the course of the last 20 years. What near-term returns look like over the course of the next 3, 6, 12 months is anybody's guess, but history suggests it'll be below average.
Yeah, and I think that spike you show on the chart, the inflows, was told out by some of the data that came out of Fidelity about the average 401k plan being down 27%. It just shows you that the public had chased after what had already done well, and then
Yeah, and Tom, I'm going to bring up Ian Bremmer again. You referenced him earlier. But, the weekly commentary, etc., he's all over the geopolitical risks of the world. I think a lot of people find geopolitical risks, or they're digesting the news and feeling like a lot of the risks that we're faced with today are unique. But this chart is meant to represent, or meant to reflect, that geopolitical risks are normal. I guess each risk itself is unique, but that's always been the case. Can you speak a little bit to kind of the normalcy of geopolitical risks?
Sure. I unfortunately or fortunately, I've lived through every one of these crises, and I'm still standing. My net worth is higher than it was 30 years ago, and many of you, that's the case as well. This chart doesn't go back quite as far as my career, which started in 1984, but we've lived through every one of these events. And I think the overwhelming message is look at the overall trend, which is certainly upward. So if you get spun up because of what's going on in the Ukraine, which is certainly not very pleasant, or what's going on in the Red Sea, or Y2K back 25 years ago, you can get spun up. It's okay. Just don't let it affect your portfolio, because patience is truly a virtue when it comes to investing.
Well, here's a quick example of this. If we were to have told somebody, and upon the outbreak, or upon Russia's invasion of the Ukraine, that European and foreign markets were going to outperform the US over the following 12 months, we would have been laughed out of the room. Nobody would have believed us, but that's exactly what happened. So you really just have to kind of tune out some of this. I think it's important to remain engaged as a global citizen, but I think it's really important to separate your portfolio from your desire to remain engaged. And speaking of turmoil, let's close this up on some conversation about this being an election year. We know that election years tend to exhibit increased volatility, and this year should be no exception. Okay, the chart on the right here shows in the dark blue what presidential election years tend to show in terms of volatility, compared to the light blue line, which is the average of other years. So expect volatility, that's the norm. But Tom, I think what's unique about this year is we're not just talking about an election year here in the US. We're talking about elections all over the world to an extent that I don't know if we've seen before. So can you comment a little bit about, this also is something that Bremer's been writing about, in terms of just the sheer number of people that are headed to the polls?
There's an enormous billions of people were going to the polls this year, but you got to remember how democracy around the globe has actually been on an uptick in the last 40 or 50 years. Our democracy certainly has been challenged. We've seen a lot of turmoil. We've seen elections. We've seen insurrection in our capital, which is tragic. But I'm actually kind of encouraged by the fact that I see people getting much more involved, much more engaged in their democracy. Voter turnout is higher, regardless of party affiliation. People are showing up and they're paying attention. Now, how they get their news, that might be a concern, but they are paying attention to their democracy. And ours, unfortunately, is no longer one of the top democracies in the world, but we're still plugging along and doing the best we can.
Yeah, and I think from a portfolio perspective, I think the number is something around 4 billion people are headed to the polls this year, or have the ability to head to the polls. And I may not get this number correct, but it's something like there's 63 elections taking place. And so if we think about volatility being above average during election years here in the US, and then you extrapolate that and you go, wow, well, there's 63 other elections taking place. Safe to assume volatility is going to be a bit higher over there as well, wherever that may be. This year has all the hallmarks of a volatile year. So we really want everybody to be prepared emotionally, understand that that is the norm, and it's not something to be overly concerned about, as evidenced by a slide that we're about to show you. But just so hang in there. If you have any questions or get spun up about anything, please give us a call. But volatility is normal this year. This is kind of a quick, just a kind of a quick example of how, as much, again, as people know not to allow their emotions to impact or influence their investment strategy, especially during presidential election years, the data suggests otherwise. And what this shows here is that in year one of a presidency, equity inflows tend to be pretty high compared to money market funds. You move into year two, equity inflows are lower, money market funds are low as well. Oh, get into year three as the election begins to creep up on us. You can see those money market flows increase pretty dramatically. And then in a presidential election year, equity inflows tend to fall pretty considerably. So this is just that reminder, and the data supports this, that do not allow your emotions to impact what's meant to be a very thoughtful and deliberate investment strategy in alignment with your plan.
And there is still an enormous amount of cash globally sitting on the sidelines that is yet to find a home in the investment markets. We don't know where it's going to be deployed. We don't know if it's going to chase after equities, value stocks, foreign stocks that we talked about earlier, or even fixed income. But there is a lot of cash out there.
Yeah, and we are going to close up on this one. Now, this chart also provides some historical perspective about how, no matter the outcome, long-term returns have been similar whether a Democrat or a Republican won the election. And we get it. We too become emotional at times as humans, about elections or outcomes. But capitalism has a very long history of prevailing. And yes, we know that every election is different. They're always different. But what I like about this chart is that nobody can say that there haven't been threats to democracy or global stability since 1936, yet markets have prevailed and have delivered long-term positive results. Again, very similar no matter the outcome of the election. Tom, anything you want to add to that one before we wrap up?
Patience is a virtue, Casey. Does that sound good?
That works. So with that then, Tom, why don't you take us home?
Why don't you go to the next slide, Casey, if you don't mind?
Oh, is there a disclosure slide? There we go.
That one right there.
Okay.
So notice the young, bright, cheery faces in this picture with the old gray-haired guy. I think it's not coming to surprise to anybody that my role within the Sidora Group has been changing. It's been evolving quite markedly, particularly in the last 5 or 6 years, where I've been taking longer vacations, sabbaticals, travel with family, and devoting less time to my work. Now, work is still very important, but officially in 2025, I would become a senior advisor to the Sidora Group. We are also going through a rebranding exercise. My last name has served me beautifully for now 40 years in a very honorable profession. But eventually, my team is going to have a different name to surround themselves around to carry on the next 40 years. Sidoric will still be the values underneath what we've created, but you'll see a new name come out eventually. And you've also, quite frankly, you've seen a new website, which is, if you've not been there, please spend some time there because it's remarkable what we've been able to create. So if you have questions of me about what I'm doing, how I'm doing it, or where I'm doing it, call me anytime. My cell phone is pretty much an open book, but 603-498-3781 is yours to call. But our team is here. The median age of the team right now is a little north of 42 years old, and I'm approaching my 70th birthday. That, folks, is an investment in you. That's an investment in continuity. That's an investment in succession. And that's an investment in your peace of mind. And on that note, I'm just going to say thank you all for joining us today. I'm grateful for your trust. Glad that you could be here. Look forward to any questions you might have.
Thank you, Tom. Well said. I think that's a wrap because we don't have a Q&A functionality here. So Thanks, everybody. We'll end the webinar now, and feel free to give a call if you have any questions.
Thank you all.
Thank you.